Hello friends, welcome back to the channel. Today in this video we will talk about the update on the RBI's Monetary Policy Committee meeting, and this will be kind of an explainer video where I will explain what decisions were taken in the meeting and how those actions affect we as stock investors. So basically RBI can take two types of stances when it comes to interest rates. Either RBI can take a hawkish stance or it can take a dovish stance. What it means by a hawkish stance? Hawkish stance means either RBI is keeping the interest rates high, it is increasing the interest rates, or it is maintaining the interest rate at a high level. In dovish stance, RBI is either lowering the interest rates or it is maintaining what is already a lower rate. So what is the effect of increasing of rates or lowering of rates? The effect on the market is on the cost of capital. When the interest rates remains high, the cost of capital for the companies increase, and when the interest rates is either low or it is falling, it is easing out the cost of capital for the companies. So what happens when the cost of capital of a company increase or decrease? When the cost of capital increases, the profit margins of the companies fall. And when the cost of capital is falling, their margins increase. So in a way, company makes more profit when the cost of capital is falling, and when the cost of capital is rising, the companies make less profits. So cost of capital has a direct influence on the profit margins of the company. And when the profit margin of the company changes, it has direct influence on the stock price of the company. If the profit margin is rising, if the company is making more profits, its stock price will also grow faster. Conversely, if the profit margin of a company is falling, its stock price will also fall. So we can see that how the policy action of the RBI is indirectly affecting the stock market. So that's why we are discussing the Monetary Policy Committee updates in this video. I think now you understand my point. So now that we have understood that how a decision taken by the RBI's Monetary Policy Committee affects the stock market, let me give you a quick introduction first, that what happens in this Monetary Policy Committee meetings, and then I will go into the details of what actually happened in this June 2026 meeting. So first let's understand the overview and then we will go into the detail. It will set the context for this video and it will make it easier for you to understand how the RBI is thinking in terms of what is good for the economy. So let's see what RBI typically does in a Monetary Policy Committee meetings. So the first thing that RBI looks upon is the repo rate, and any changes in the repo rate is done with the objective of controlling the inflation. And why RBI wants to control the inflation? Because by controlling the inflation, they can in turn control the GDP growth rate of the country. So basically these are the 3 points: the repo rate, the inflation, and the GDP growth rate, that the RBI is looking at from the bird's eye view. For the economy, they want to control the repo rate in turn to maintain a acceptable level of inflation, so that the GDP of the economy keeps growing at the rate at which the government wants. So now we are ready to talk about what happened in this June 2026 Monetary Policy Committee meeting. So the decision on the repo rate is taken by RBI's Monetary Policy Committee, and this Monetary Policy Committee consists of 6 members. 3 are from the RBI and 3 are government nominated representatives. From the RBI side, there is Governor of the RBI, the Deputy Governor of the RBI, and the Executive Director of the RBI. And the 3 government nominated representatives, these are basically economists or head of renowned respected institutions of the country. This Monetary Policy Committee meeting happens on bi-monthly basis. This time it happened in June, and before this Monetary Policy Committee meeting took place in April. So every 2 months these meetings take place. In this current June Monetary Policy Committee meeting took the decision on the repo rate. They kept the repo rate unchanged, means whatever was the repo repo rate in April 2026 meeting, they kept the same repo rate in this meeting as well. So in the current MPC meeting, the repo rate was kept at 5.25% and it was the same rate in the April meeting as well. What is repo rate? Repo rate is basically that rate at which RBI gives loan to the banks. If banks require money to give, let's say, loan to us in the form of home loans or personal loans or car loans, and if banks think that there is excess demand for the loan, what they will do? They will ask RBI for the money and RBI will give the money to these banks as loans. But you have to understand here that the banks can borrow money from RBI, but they have to give a collateral to take this money. And what is that collateral? The collateral are the government bonds. So this is an important difference. I will explain why it is important to understand this, because if a bank want a loan from RBI at repo rate, they will have to keep government bonds as a collateral. This is important. And repo rate is the lowest rate that RBI will charge to the bank. This is the lowest rate. So if you have to get the lowest rate, you have to give a collateral in the form of a government bond. Now, in a monetary policy committee meeting, the decision is not only taken on the repo rate. There are three more rates. Those three rates are SDF, which is standing deposit facility. The other is the MSF, which is marginal standing facility, and the third is the bank rate. So whatever is the repo rate, the SDF will be minus 0.25%. Whatever is the repo rate, the MSF will always be plus 0.5%, and MSF and bank rate will always be equal. This is the standard policy of RBI, and this is how they set all these four rates at tandem: the repo rate, the SDF, the MSF, and the bank rate. So we have already understood that what is repo rate. Repo rate is the loan that banks can take from RBI, but for that they have to give a collateral. And what is the advantage of taking loan by keeping a collateral with RBI? You will get the lowest rate. The lowest rate is this repo rate is the lowest rate. But suppose banks do not want to keep a collateral. They want to take the loan from RBI, but they do not want to give the collateral for whatever reason. So in that case, the banks can take the loan from RBI, but at a bank rate. You can see repo rate was 5.25%, but this bank rate is 5.5%. So RBI says, if you want a lower rate, give me the collateral. And if you do not want the lower rates, I can still give you loan, but you will get at a bank rate. So this is the function of bank rate. So what is SDF? SDF's utility is also very simple. Suppose there is a bank which has a lot of cash and banks wants to earn some interest on that excess cash. So what they will do, they will transfer this SDF to RBI and they will say, hello RBI, I have so much excess cash. Can you keep my money with you and give me some interest? So RBI will accept that excess cash and they will offer an interest rate of 5% to that bank. Now let's understand what is MSF. Suppose there is an emergency for the bank and bank wants to raise funds on the overnight basis. So they will approach RBI and they will say that there is an emergency. I want money urgently. So in that case, the RBI will not ask for any collateral. They will not ask for, okay, wait, I will give you in 2 days. They will not do these kind of things. Overnight, they will issue the funds to the bank. But in that case, the RBI will charge a higher interest rates more than the repo rate. And that rate is called MSF, marginal standing facility. In RBI's term, all these four rates in combination is called liquidity adjustment facility. What is the function of liquidity adjustment facility? These are basically the four control parameters that RBI has that they can alter and change the liquidity that is there in the economy. If they want to lower the liquidity, they will increase these rates. If they want to increase the liquidity in the economy, they want to give more money into the economy, they will lower these rates. So these four rates are a facility in the hands of RBI to adjust the liquidity of the economy. So these four rates are for the liquidity adjustment facility. So what RBI has done in this June MPC meeting, they have kept all these four rates same as what it was in the April MPC meeting. So now we have to understand that what is there in the minds of RBI that they have kept the rate as same as in the last April. So whenever RBI governor comes and declares the monetary policy committee meeting updates, they not only tell about what are the rates that they have finalized, they also give an explanation that what they are thinking at present to keep the rates the way they have decided. So in this June MPC meeting, RBI has indicated that they have not lowered the interest rate. They have kept the interest rate at a higher level as it was in the April. So why they have not lowered the interest rate? There is a clarification for that. And the words that RBI has used to explain their stance on the repo rate and other rates is that the economic environment is uncertain. Generally, we all stock market investor wants to see that in the monetary policy committee meeting whether the RBI governor had decided to lower the interest rate or not. Our interest is always to find if the rates are falling or not, because a falling interest rate has a good influence on the cost of capital, and when the cost of capital will fall, the stock market will show a bullish stance. As a stock market investor, we are always looking that if RBI is thinking that whether the interest rates can be lowered or not. But this time RBI has decided to keep a neutral stance, means whatever they have decided in April, they will keep the same interest rate now, and at present the interest rates are at a higher level because this is what the RBI has explained that why they have kept a neutral stance. So what is causing uncertainty in the minds of RBI? There are two things. First of all, there is a West Asia crisis where US and Iran and Israel are fighting a war and they are not able to reach at a consensus. They are not, one day they are deciding that they will stop the war, other day they are continuing with it. A lot of to and fro negotiations are going on, but still that war has not stopped. So this is the first layer of uncertainty. And what is the after effects of this war? The after effects is the energy price, the crude oil price is rising, and a country like India has to face the burnt of it because we import almost 85% of our all crude oil demands. So for us the energy price is rising. And the second effect of the West Asia crisis is the trade route disruptions. Not only crude oil, we are not able to receive or send our exports to other countries because the Strait of Hormuz is disturbed. The ships are not flowing to and fro easily through that strait. The second kind of uncertainty that is playing in the minds of RBI is related to the monsoon and the El Niño effect. IMD has forecasted that this time the monsoon will not be as good as it used to be in the past. We will have less of rainfall this year. And moreover, we also have the effect of El Niño where the temperature all over our country is rising. So the effect of lack of rain and high temperature will have effect on the food supply. So basically there are two types of uncertainties playing in the minds of the RBI. The first is the West Asia crisis, and second is the weather related thing like monsoon and El Niño. These are the things that are causing the uncertainty. So what is the after effect of this uncertainty? The after effect is high inflation. When energy price will rise, when due to trade route disruptions, due to food supply problems, what will happen? The inflation of the economy will rise. So what is the problem with inflation? What happens if inflation goes up? When inflation goes up, the real GDP growth of the economy slows down. So the effect of high inflation is on the real GDP growth rate. What is real GDP growth rate? Suppose the nominal GDP growth rate is 10% and the inflation in the economy is 8%. So in this case, the real GDP growth rate will only be 2%. So it is very important to keep the inflation rate low so that the real GDP growth rate, the differential between the nominal GDP growth rate and inflation stays at high level. So if inflation is high, the real GDP growth rate will show a smaller number. So till now we have seen that RBI has mostly kept the same rates as it was in the April meeting. In the April meeting, the repo rate, the SDF, the MSF, the bank rate, all rates were kept at same. But this is that number where you will see that why RBI is concerned, why it is not lowering the interest rate. The concern you will find here now. And the concern is the GDP growth rate forecast. In the June meeting, RBI has forecasted a GDP growth rate of 6.6%. But in the April meeting 2 months back, they forecasted a GDP growth rate of 6.9%. So you can see, because of inflation concerns, RBI is forecasting a lower GDP growth rate number for the economy. The GDP growth rate number is falling, and during the speech of the RBI governor, the RBI governor has given a hint that there are signs of moderation of growth in some sector. During the RBI governor's speech, the governor has given a hint that why they have lowered the forecasted GDP growth rate for India is because there are signs that there is a moderation in the growth rate of some sectors. This is a very important thing to understand for we investors, that how RBI comes to know that the growth rate in some sectors are falling, and for that we have to understand a term which is called as high frequency indicators, HFIs. So what are these high frequency indicators? So basically there are 5 high frequency indicators that Reserve Bank of India keeps watching from its level to understand if the economy is growing as fast as it has done in the past. So these 5 high frequency indicators give a feel to the RBI that whether the economy is slowing down or it is accelerating. So what are these 5 indicators? The first is the e-waybill generator. The second is the UPI transactions that are happening in the economy. The third is the monthly auto sales that is happening in the market. The third is the daily electricity consumption that are being consumed at industry level or at a household level. And the fifth is the purchase managers index. This is basically RBI's way of looking at the corporate transactions. And why it is called purchase managers index? Because if the purchase department of the company is ordering more items, it is a good sign that the economy is growing as fast. If the purchase manager is ordering less items, it is cutting the costs, then it is a sign to RBI that maybe the corporates are willing to cut down its cost. They do not want to go as aggressive. This is a sign of moderation of growth. So what RBI is basically saying that they are observing a slight slowdown in these day-to-day activities, in these day-to-day indicators, and that's why they are thinking that there is a moderation of growth that is happening, and that's why they have kept a neutral stance. They have not increased the rates, but also they have not decreased the rates. So high frequency indicators are basically RBI's way to look at the consumer behavior and also to look at the business activity of the companies operating inside India. So when changes are observed in the consumer behavior and business activity on day-to-day basis, RBI keeps a note of it, that what is the trend when they are watching the consumer behavior. Are they spending less? If the business activity is slowing down or it is growing. So on day-to-day basis, they are observing this data, and eventually when they see a continuous trend for the next 2 months, that if the consumer is spending less, if the businesses are spending less, then they extrapolate this observation to the repo rates, the other rates that they find, to judge if the GDP is, how fast the GDP will grow in the future, how the inflation is going to play out in the next few months, and what rates they should finalize to keep a control on the inflation and the GDP growth rate. For us, it is important to understand when RBI decides to increase, decrease or maintain the repo rates, it is not that on that particular meeting date that they have finally decided that okay, the repo rate should be like this. No, before that day, on daily basis, they are observing these high frequency indicators, and after observing all these indicators continuously for 2 months, that they translate this data into the GDP growth rate and to the inflation and then to the repo rates and other rates. So that's all, my friend. I think you have understood that what goes behind a monetary policy committee meeting of the RBI, on what basis they decide the repo rates, how they control the inflation, how they forecast the GDP growth numbers, what kind of data they observe on day-to-day basis to make a right decision in the monetary policy committee meetings. If you like the way I have explained this complicated topic, please do consider subscribing to my YouTube channel, and I will come up with a new video very soon. Thank you very much for watching.